Welcome to Fatrit Killer's weekly crypto alpha. Let's cut through the noise. Dubai banned Monero 18 hours after it hit all-time high. Not 18 days, not 18 weeks, 18 hours. At 2 a.m. on January 15th, XMR touched $797. By 8 p.m., Dubai regulators issued a complete trading ban. HTX suspended deposits before midnight.
The regulatory response time went from years to months to weeks. Now it's measured in hours.
This is the first strange thing. Here's the second. Goldman Sachs, JPMorgan, and BNP Paribas run validator nodes on the same blockchain. Together, right now. The network is called Canton. It processed $300 billion in settlements last Tuesday. That's not a typo. $300 billion in a single day. For context, that's more than most stock exchanges. More than the entire crypto market cap in 2020, moving through a network that has zero retail access, zero token speculation, zero mainstream coverage. Nobody on crypto Twitter mentioned it. Not once in the top 500 threads. Not in any major newsletter. $300 billion invisible.
Third strange thing. JPMorgan's CFO stood up on January 14th and called interest-bearing stablecoins clearly dangerous and unwelcome.
The same JPMorgan running validator nodes on Canton. The same week, the same bank, opposite messages. There's a pattern here. Let me show you what connects them. Our models flagged January 15th as a statistical anomaly. Information volume hit 4.7 standard deviations above normal. We traced what triggered it. 3 parallel narratives collided. Narrative 1. The privacy crackdown. XMR banned in Dubai. HTX suspensions. The entire Zcash team resigned 8 days earlier. Privacy coins went from institutional demand to regulatory target in 1 week.
Narrative 2. The institutional build-out. Canton processing $300 billion daily. Morgan Stanley filing for a Solana ETF. DTCC tokenizing treasuries. Wisdom Tree launching staked ETHETPS in Europe.
Narrative 3. The platform execution. Twitter changed one API policy. InfoFi protocols worth billions collapsed overnight. Kaido shut down Yaps. Cookie closed Snaps. XEET entered maintenance mode. These aren't separate stories. Watch the capital flow. Monday, JPMorgan CFO attacks crypto savings accounts. Tuesday, same JPMorgan processes billions through Canton validators. Wednesday, XMR hits all-time high at $797. Thursday, Dubai ban issued, HTX suspensions begin. Friday, XAPI policy kills InfoFi sector. Morgan Stanley files SOL ETF. Saturday, Canton settles another $300 billion. Zero coverage. The money knew before the press releases. Now here's what almost nobody tracked. The 18-hour regulatory response to XMR isn't just fast, it's coordinated. We trace the information flow. Dubai's announcement came from VARA, their Virtual Asset Regulatory Authority. But the language matched verbatim with draft guidance circulating in Singapore 3 weeks earlier. This wasn't one regulator moving fast. This was multiple regulators moving together.
The playbook. Wait for ATH when retail attention peaks, then strike simultaneously across jurisdictions. Maximum visibility. Maximum deterrent effect.
Privacy coins didn't get banned because they failed. They got banned because they succeeded. But there's a darker layer to the privacy story. 52% of AI agent payments through X402 protocol were in XMR. The machines chose privacy. The regulators chose to stop them. Here's the trade-off nobody's discussing. AI agents need privacy to function commercially. If Agent A pays Agent B for data, and that transaction is visible, competitors can reverse engineer the business model. Privacy isn't a feature for machine commerce. It's a requirement. So the regulators just banned the payment rail that AI agents preferred. What happens next?
Canton Network. Selective disclosure. Show regulators what they require. Hide everything else. Institutional-grade privacy that Dubai won't ban because Goldman runs the validators.
The future of privacy isn't anonymity. It's permission-based transparency controlled by the entities powerful enough to negotiate their own rules. Now let me show you the calendar that matters. January 17th, Ondu unlocks 1.9 billion tokens, $7.57 billion at current prices. Pantera and Founders Fund hold at below market cost basis. The unlock increases float by 60%. January 19th, AXS Binance Prime sale. Axie Infinity restructured their economics. Employee salaries now paid in AXS to reduce sell pressure. Korean exchange volume surged 312% this week.
January 20th, Sentient TGE, the most anticipated AI token launch since virtuals. They announced no new information pre-launch, which historically correlates with confidence, not weakness.
January 21st, hyperliquid unstaking window opens. $2.1 billion in staked hype becomes liquid. The protocol cut fees to 0.005% maker, triggering a fee war across perpetual DEX. January 22nd, Linea airdrop distribution. Plus RLUSD and PYUSD go live on interactive brokers. Traditional brokerage, stablecoin rails opening. Same week, MyCA full enforcement countdown hits 12 days. Most retail thinks MyCA is already live. It's not. The comprehensive requirements haven't even started. This isn't coincidence. This is calendar arbitrage. One more anomaly you should know about. We track wallet creation patterns across L1s. Solana added 4.2 million new wallets this week, but 78% came from two sources: MediaTek chip integration announcements and Xiaomi retail distribution.
Neither has a directly tradable Catalyst token. There's no MediaTek coin. The trade is second order. Which protocols benefit when pre-installed wallets ship on 2 billion devices?
By the time this shows in prices, the positioning window closed 18 months ago. Now the hidden signal that has zero Twitter presence. Figure filed with the SEC to issue blockchain-native stock. Not tokenized stock, native stock. Trading simultaneously on NASDAQ and Solana. Read that again. A company is asking SEC permission to have shares exist on a blockchain as the primary record, with NASDAQ as a secondary venue. Galaxy Digital announced the same structure days later.
This isn't RWA tokenization. This is equity native issuance. The distinction matters because it bypasses transfer agents, clearinghouses, and settlement systems entirely.
The SEC is reviewing applications that would make traditional stock infrastructure optional. The entropy score for native digital securities was plus 340%, highest of any sector this month. The attention is crystallizing. The regulatory path is opening. But the tokens that capture this value don't exist yet. One final phenomenon: ERC-8004 deployed on January 16th. You probably didn't see it. The standard creates on-chain reputation registries for AI agents. Know Your Agent, KYA, compliance infrastructure. This is the legal personhood layer for non-human economic actors. Agents that transact millions of dollars need identity. They need credit scores. They need dispute resolution. ERC-8004 provides the skeleton. What gets built on it determines whether AI commerce routes through crypto or traditional rails. The standard processed its first 10 million agent identity registrations before anyone wrote a thread about it. Here's what this means mechanically.
We ran hypothesis tests on leader versus follower returns in each sector. In most sectors, L1S, DeFi, memecoins, no significant difference. Rising tide, all boats.
Two sectors showed statistical significance at PIB less than 0.01. Institutional settlement infrastructure, leaders up 89%, followers flat. Machine payment protocols, leaders up 71%, followers up 12%. The gap isn't marginal, it's structural. In these categories specifically, picking the leader matters more than picking the category. Don't spray across the sector. Pick. The week ended with crypto split in two. Door 1, Canton, tokenized treasuries, SEC registered securities, compliant stablecoins, institutional money flowing in faster than ever. Door 2, privacy coins, interest-bearing stables, InfoFi protocols, regulatory pressure accelerating, response times compressing from years to hours.
The entities going through Door 1 share a characteristic. They make regulated finance more efficient.
The entities getting stopped at door 2 share a different characteristic. They compete with regulated finance without permission. Same industry, same week, different futures. Somewhere in Dubai, a regulator is already drafting the next ban. Somewhere in Canton, Goldman is already processing the next billion. And the only trace they leave is a settlement pattern we'll recognize too late. Follow me on X at FatRatKiller for more alpha that satisfies your intellectual appetite. See you next week.